Okay, let's peel back the layers. Today, we're doing a really fascinating deep dive. We've got some sources here that really illuminate the intricate world of SAP S4 HANA Cloud.
Hmm.
And this isn't just about software, right? It's about digging into the detailed mechanics of how modern businesses are managing finance, operations, even their digital transformation.
That's spot on. And these details, they might seem technical, maybe a bit dry on the surface,
Sometimes, yeah.
but they offer such crucial insights. Insights into how core business processes, everything from sales, production, right through to financial reporting, how they're actually designed and executed within a pretty sophisticated cloud ERP.
Right.
And what's really fascinating, I think, is seeing how these seemingly small configuration choices can have this huge ripple effect,
Yep.
a big impact on data accuracy, and even how well a business understands its own performance.
Absolutely. So our mission today for you listening is to really distill these insights. We want to pull out the most important nuggets, those real aha.
Yeah, those moments that clarify things.
Exactly. Clarify how this powerful system works behind the scenes so you can walk away feeling genuinely well informed about, well, the capabilities and the considerations of a system like SAP S4HANA Cloud.
Sounds like a plan.
Okay, so let's jump right into where it gets really interesting, the financial flows. I'm genuinely curious what actually happens, like under the hood, when a product physically leaves the warehouse. Let's say in a scenario with event-based revenue recognition and CUDGS split active.
Okay, yeah, good place to start. So when that goods issue happens, it's not just, one single posting like an older system sometimes. It's actually a key part of getting that real-time financial view.
Right.
The system, it intelligently creates 3 separate documents
Yeah.
right at that moment.
3. Okay. What are they?
So you get one for the physical inventory movement. That's your standard goods issue, right?
Yeah.
Tracking the stock.
Makes sense. Standard stuff.
Exactly. Then number 2, and this is critical, you get a document specifically for the CUDGS split.
Breaking down the cost of goods sold.
Precisely. Into its different components, material cost, labor, overhead, whatever you've configured.
And the third.
The third one, that's for the event-based revenue recognition. It immediately accrues both the costs and the expected revenue tied to that shipment.
Wow. Okay. So finance gets an instant snapshot.
Pretty much. Immediate granular insight into inventory levels, the cost breakdown, and that accrued revenue right when it ships, not, weeks later at month end. That's a huge difference from traditional batch processing.
That real-time accrual, yeah, that sounds incredibly powerful for just immediate insight. But what if, say, the final invoice amount is different? Maybe a discount is added later or something changes after that goods issue. How does the system handle that? How does it make sure those initial accruals match the final bill the customer gets?
Right, that's a great question. That's where the system's intelligence really comes into play. When the actual billing document is created, assuming event-based recognition is still active, the system performs 2 really crucial adjustments automatically. First, it generates an offsetting entry for the adjusted revenue. So it essentially clears out that preliminary revenue number that was accrued back at goods issue.
It reverses the first estimate.
Kind of, yeah.
Right.
It clears it and posts the definitive actual revenue based on the final invoice. Then second, those planned costs that were accrued earlier, they get recognized as adjusted costs. So it finalizes them to match the actual reflected in the invoice too.
Okay, so it keeps everything perfectly aligned, from the warehouse estimate to the final financial statement.
Exactly. It ensures every penny lines up.
So understanding this kind of intricate flow, it brings us to a really important question for any business, right? How do you really know how profitable a specific sale actually is? Where does the sales order cost estimate fit into all this? Is it just like a rough guess?
No, it's definitely more than just a guess. The sales order cost estimate, it's kind of like an early warning system for profitability and a key planning tool. It really serves 2 critical purposes in S/4HANA Cloud.
Okay, what are they?
First, it's the fundamental basis for your cost of goods sold, your COGS, when you look at margin analysis reporting. Right. By setting that planned COGS value up front, based on the estimate, businesses can immediately see if their actual costs are starting to veer off course, way earlier than they might have before.
So you can react faster if costs are higher than expected.
Exactly. It turns profitability analysis from just looking backward into, well, a real-time lever for making decisions. And secondly, that same cost estimate is the foundation for calculating target costs.
Target costs.
Yeah, as part of a production order's variance calculation.
Right.
It lets you compare what you plan to spend based on that estimate against what you actually spent making the product.
So for performance analysis. finding efficiencies.
Precisely. It allows for really detailed performance tracking and helps drive continuous improvement.
That granular insight is really powerful. Okay, shifting gears just a bit, let's dive deeper into the controlling side of things. A system like this can get incredibly detailed with managing costs, as we've seen. What kind of specific power does something called a cost center category give you?
The cost center category. It's actually quite powerful because it directly controls specific functions, specific behaviors within a cost center. You can think of it like setting the rules of engagement for that particular cost bucket in your accounting system.
Rules of engagement, I like that. Like what?
Well, for instance, it determines whether you're even allowed to record consumption quantities for that cost center.
So tracking how much material or service was used?
Exactly.
Right.
It prevents, say, your marketing cost center from accidentally recording raw material usage, which wouldn't make sense, right?
Keeps things logical.
It also controls whether you can post actual secondary costs. That means, can this cost center receive costs that are allocated from other places, like from a shared IT service department, for example?
Okay, so it dictates how costs flow in.
Correct. And finally, it dictates whether you can record commitments against that cost center, things like tracking future expenses from a purchase order that's been raised but not yet paid.
Got it. So it really defines what a cost center can and can't do financially.
Precisely. Granular control.
That control over individual centers is obviously essential. But, businesses rarely operate in neat little silos. What happens when costs or maybe even revenues need to be shared, like shared services costs, IT maybe needing distribution, or revenue from one big deal needing to hit multiple profit centers? That sounds like it could get messy without the right tools.
Yeah, you've definitely hit on a core challenge there, and that's exactly what profit center accounting is designed to tackle, specifically through allocation functions.
Okay.
It's built precisely for distributing costs and revenues accurately, making sure they land in the right profit centers. This gives you that true picture of segment profitability.
So the shared IT cost example.
Yep. Costs initially posted to maybe one central IT cost center can be systematically allocated, distributed out to the different profit centers that actually, benefited from those IT services based on usage or headcount or whatever method you choose.
Makes sense. And for revenue.
It works for revenue too. You can allocate revenues posted perhaps to a single P&L account, that's your profit and loss account, where income and expenses live. You can split those revenues from one transaction across multiple profit centers if needed, to reflect each segment's actual contribution.
Right, so everyone gets a fair slice of the pie reflected accurately.
Exactly. It gives every part of the business a fair and accurate view of its own financial standing. Super important.
Okay, so we've explored a lot of the inner workings, once the system is up and running, but that kind of begs the question, how do businesses even get to this point? This level of precision doesn't just, poof, appear overnight.
No, definitely not.
So that brings us to the actual journey of implementation. Let's talk about SAP Activate. What's the main goal of something called a fit-to-standard analysis during the explore phase? I imagine it's a balancing act between standard ways of doing things and unique company needs.
That's a really good way to put it, a balancing act. The primary purpose of that fit-to-standard analysis is really to proactively confirm that the customer's existing business processes can, in fact, be mapped effectively to the SAP best practices delivered with the software.
So seeing how well things align out of the box.
Exactly. It's usually done through workshops. You get business users, system experts together. They walk through the standard SAP processes step by step.
And the big benefit.
The huge benefit is identifying any gaps areas where the standard doesn't quite meet the need really early in the project. This drastically reduces the pressure and the need for custom development later on.
Which saves time and money, presumably.
Absolutely.
Yeah.
But it's more than just cost saving. It minimizes risk, it helps accelerate the deployment, and crucially, it makes the system easier to maintain and upgrade down the line because you've stuck closer to standard. It's strategic.
Makes perfect sense. And even before you get to that fit the standard stage, there's an even earlier phase, right? The initial discovery. What's the core purpose of the digital discovery assessment? That happens right at the beginning of SAP Activate, doesn't it?
It does, yeah. It's right there in the initial discover phase.
Yeah.
Its main job is to identify the critical integrations and any extensions the customer is going to need.
So things outside the core S/4HANA system?
Pretty much. It's about figuring out upfront any unique requirements that go beyond the standard offering, maybe connections to legacy systems that need to stay, or specific third-party tools, or perhaps some highly specialized functionality they absolutely need.
Why is that so important early on?
because it helps define a realistic project scope from day one. It avoids those nasty surprises later, where suddenly you realize you need a complex integration you hadn't planned for. It ensures the final solution will genuinely meet all the customer's critical needs, not just the standard ones.
Okay, so you get the scope right from the start. Good. So let's say we know what we need now. The next massive hurdle is often getting all that existing business data moved over, right, into the new system cleanly, and then making sure users can actually use the thing.
Yep, data migration and user experience. Two huge pieces.
How does S/4HANA help with that data migration step? What tools are there?
The standard, and really the go-to tool, is the SAP S/4HANA Migration Cockpit.
Migration cockpit. Okay, what's special about it?
Well, its core characteristics are really designed to de-risk what can be a very complex process. It gives you guided steps to follow. And critically, it includes a simulation function.
Simulation, like a practice run.
Yeah, exactly. You can test the migration thoroughly, see what errors might pop up, fix them, before you actually commit the real data load. It's invaluable for data integrity.
I can imagine.
And it also provides robust tools for mapping your source values, the data formats and codes from your old system to the new SAP S/4HANA target values, ensuring everything translates correctly and stays consistent.
Like having a dress rehearsal and a translation guide rolled into one.
That's a good analogy, yeah.
Okay, critical for a smooth cutover. Now let's flip to the user side. Once it's all live, we've probably all experienced this somewhere. You know you're supposed to have access to an app, but you just can't see it on your dashboard, your launchpad.
Oh,
In the S/4HANA world, what are the likely culprits if an app isn't showing up on a user's Fiori launchpad, even if they technically have access?
yes. The mystery of the missing Fiori tile. It can be frustrating for users. There are usually two main configuration reasons why this happens.
Okay, what are they?
First, the user's business role might not have been assigned to a launchpad space.
That's space.
Yeah, the newer Fiori launchpad uses spaces and pages to organize apps. Think of them like personalized dashboards or work areas. If the specific space containing the app isn't assigned to the user's role, the app won't appear, even if they have permission for the app itself.
Ah, okay, so the app's container isn't visible.
Sort of, yeah. And the second common reason is that the application itself isn't included in any of the user's assigned business catalogs.
Business catalogs.
Right. Apps essentially live inside these catalogs, and those catalogs then get assigned to business roles. So the app needs to be in a catalog, and that catalog needs to be linked to the user's role for the app tile to show up on their launchpad.
Got it. So it's about connecting the dots. App to catalog, catalog to role, role to space, and role to user.
You got it. It ensures the right user sees the right tools, all neatly organized for their job.
Finally, let's just zoom out one last time to the really big picture. What are some of the defining characteristics of the SAP S/4HANA Cloud Public Edition system landscape itself? What really sets it apart, especially for businesses thinking about a true cloud strategy?
Okay, the public edition. Two key things really define it and offer significant benefits. First, it's a multi-tenant environment, and it's managed entirely by SAP.
Multi-tenant meaning shared infrastructure.
Correct. Many different customers or tenants share the same underlying hardware and software infrastructure. Like living in the same apartment building is a common analogy. Your data is totally separate and secure, of course.
Right. And SAP manages it all. Updates, maintenance.
Yep. SAP handles all the system updates, the maintenance, the infrastructure management. That significantly reduces the burden on a company's internal IT team. That's a huge plus of public cloud.
Okay. And the second defining feature?
The second one, and this is crucial for flexibility in the cloud, is how extensibility is handled. Custom developments, basically.
How do you customize in the public cloud? I thought that was restricted.
It's managed differently. Primarily, it's done through the SAP Fiori Launchpad itself, using approved in-app or side-by-side extension tools provided by SAP. The big advantage here is that these extensions are designed to be upgrade safe.
Upgrade safe, meaning they don't break when SAP pushes an update.
Exactly. Because you're using the approved frameworks, your custom enhancements are protected during the frequent updates SAP delivers in the public cloud. It allows businesses to innovate and tailor the system without the constant fear of breaking things with the next upgrade cycle.
That's a major point for continuous innovation. Knowing now how these underlying system behaviors like real-time financials or upgrade-safe extensions actually work, or how a disciplined methodology like Activate really shapes the outcome, how might this new understanding change how you approach things? How might it influence your next business process improvement idea or your company's digital transformation strategy? or even just how you approach making the next big decision within your own cloud ERP environment. Definitely something to think about, the strategic advantage this kind of deeper knowledge can really give you.